So if you remember the last rate update video, I said around October 10th, that's where we're going to see interest rates likely change their direction and go for the direction of improvement. Don't expect to see most of those changes until we get to about October 10th. A couple other pieces play into that, such as some of the data reports that are coming out. And so back in September, we tried to break the ceiling and we got rejected. The ceiling I'm referring to is these two close lines together. The first part to do that was getting over the thicker green line. The thicker green line is thicker because it's more important or a harder level of resistance. Now, at this point, we've cleared it today, and so the next objective is going to be seeing if we can go ahead and break this next ceiling where the two lines are closer together. If that happens, that's where we're going to see interest rates probably improve by an eighth, if not a quarter percent. You're going to see pricing improve by probably nearly 100 basis points if we can break that next ceiling. There's also something else I want you to factor in that I haven't gone into in the other videos, and it's the unemployment interest rate. And unemployment plays a very big key on what happens with interest rates. So what you're going to be seeing here on this screen is now the unemployment trend for the last several decades. This is going back to 1948 on the far left-hand side, and it's current day on the far right-hand side. Now here's the part that I want to point out that's very important. This red line that you see here is at the level of 3.9%. Every time we break 3.9%, unemployment ends up going higher. That is when interest rates usually get better. You have to remember that the only way the feds can go ahead and stimulate the economy is by lowering interest rates so that way they can put more money into it to try and combat unemployment. When we go back to the interest rate, I'm going to throw in unemployment here, and I'm going to take off everything on the screen just to make this a little bit easier to see. And so what I have now, it's going back to 2014 on the left-hand side, and I'm going to add in the unemployment aspect of it. Now, the unemployment is a blue line, and this is the part that is very important. Every single time that we go above 3.9%, so think about 2008, when we broke that 3.9%, unemployment soared, and so did the mortgage bond pricing. When unemployment went to the highest point, that's when the bond pricing went to the best pricing we've ever seen. That's when interest rate went down to 2.5, 2.99%, 2.25 if it was FHA or VA. And same thing is going to happen at this point. Not saying we're going to go back to 2.5%, but as unemployment soars and it gets above 3.9%, that's when we're going to see interest rates improve, because that's the only way the feds can throttle and actually manipulate the interest rate or the economy to get the economy doing better and performing better. Essentially lowering rates, putting more money into the economy by letting borrowing become easier access. So do I think you're going to see 2.5%? No, but if this breaks the ceiling that we're hoping for, which is the two short line or the two lines that are closer together, if it ends up breaking that point, that's where we're going to probably see rates again get better by at least a quarter percent. If it continues to ascend after that next ceiling, then really we'll see where the next stop is at that point, but you can expect even better pricing. And then we should see some more improvement next week, assuming that we don't get rejected at that ceiling.